Hello and welcome to another episode of FINtalk. Today we're going to recap on what happened this year and see the outlook for the next year. So let's dive right into it. So what happened this year? This year was dominated by inflation, recession, and continuing supply problems, especially for energy and other raw materials. Beginning now back in March 2021, inflation, represented by a CPI headline, soared for the rest of the year and right into 2022, which began with 12-month CPI of 7.5. Now, the war in Ukraine pushed this number even higher by adding pressure on energy, wheat, and other commodities. At the same time, price levels for agricultural commodities, they soared, as we say, throughout February and peaked by June. And to nobody's surprise, energy, represented by crude oil here, touched $122 per barrel in June. This is when inflation peaked at 9, and the S&P 500 was at a year-to-date low of negative 23. That's when we saw that recession became obvious after 2 negative GDPs. Since then, oil dropped from $122 to $81 per barrel, almost back to where it started the year at $76. Similarly, agricultural commodities price levels dropped to where they were in January, while the S&P 500 rallied to 4,080 points, almost 11% from June. In addition, Q3 GDP came out positive with 0.75%. Now, what's remarkable throughout all of this economical swirl is the solid unemployment rate, which kept steady by continuously adding jobs to the labor market. Moreover, the historical rate increases, which the Fed championed, led to the fastest increase in yield seen in decades. This created an opportunity for fixed income investors to lock in historical yield. For instance, in December last year, the 10-year US Treasury rate was at 1.5, while today's rate is 3.6. Now, the peak was back in October with 4.22. So GDP and unemployment and inflation are the most important numbers to look for in the upcoming 2 quarters. The best case scenario here is to see dropping inflation, accelerating GDP growth, and solid unemployment. While the worst case is to see consecutive negative GDP and rising or at least stubborn inflation with rising unemployment. Investment-wise, while nobody has a crystal ball, we know that the Fed will probably not continue to raise rates at the same pace, which signals that time to invest in fixed income is not yet behind us, as long as it matches investment objective. On the equity side, it will be difficult to see the energy sector outperforming the market the same way it did this year, assuming no unforeseen supply issues take place. On the other hand, defensive sectors like utilities, consumer staples, and historically sensitive to inflation, which leads to the assumption that they will become less attractive as inflation eases. As always, if you find this video to be informative, feel free to check out our content library, and feel free to shoot us an email with any question you may have. Wish you a Merry Christmas, Happy Holidays, and joyful time with your friends and loved ones. See you next year.